He's a rational investor. Live the day in Chester. Save some of his paycheck just like all his ancestors. Him looking for high yields, that's never the case. He's seeking 6% returns, low instead he wins the race. When he checks his accounts just to see what they're fielding, it's like driving in Maryland, ain't nobody yielding. What is he to do? He shouldn't be in a drought, so he visits his advisor just to sort it all out. Inflation's higher than your bond rate, that's what I was fearing. So your savings account is slowly disappearing and your CDs are pointless. That's not very funny. What would you like me to do? Put it all in dog money. Dog money, dog money, dog money, dog money. I'm trading it in for dog money, dog money, dog money, dog money, dog money. I'm putting it on the dog money. My 401k is now a 401k now, and some of my net worth they no longer in a straight line. I'm making small moves, I ain't gonna be a pawn. I sold my IRA and bought an NFT of one. Balling on Doge, I dish you out like a Tommy gun. You think I was stayed with the way I'm passing on Washington? Let's be like Matt Gates, you know what I mean. Assuring everybody it's above 18. It's a modern day gold rush, the prices will boom. Like Reggie White versus the Analysts, I'm headed straight to the moon. My broker's calling, you know that it's on. Bad dog money, don't stop till it's dawn. 1 more airbase, 2 more museums, 3 more walls, 4 more Supremes, 5 more stadiums. We're all out of fiat. Can you take trillions of these and go and make a zero? Pay our debts in our currency that might be unfurled if it's no longer the reserve currency of the world. Confidence in the dollar is permanent. Just ask any scholar. People are exchanging their dollars for dog money. Dog money, dog money, dog money. We trading it in for dog money, dog money, dog money, dog money, dog money. I'm putting in all the dog money.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500. And what we saw today was almost an inverse of yesterday. We saw the tech names, Nvidia, Microsoft, Amazon, Google, Meta, Apple to a degree outperform the broader market, whereas the Trump-heavy trades, Tesla, industrials, real estate, financials took a little bit of a breather. Stocks have run hard and strong very quickly, and in the short term, this leads to some profit taking, especially in the names that really have outperformed, especially when Tesla's up 35-40% in like 6 or 7 days worth of trading. You are definitely going to get profit taking, and that's really what we saw. And then yesterday, big tech underperformed, and they really held up the market today. However, net, broad-based indices were still down, all things considered, but there were some very bright spots in the market. Shopify dropped their earnings before the bell. They were up 22% on the day. Spectacular earnings across all of their metrics, GMV, GPV, MRR. We saw massive gains across the board. Revenue is up 26% year over year. Operating margin expanded 6 percentage points, and they also guided for high to mid 20s growth next year. So extremely strong earnings, the street recognizing those strong earnings, and Shopify up 22%. The stock was $50 just 4 or 5 months ago after a quote unquote terrible earnings report on slowing growth, but that was bridge under the water now, and the stock's probably going to 120 in the next couple of days. Home Depot also reported quarterly earnings. They beat earnings, beat revenue estimates. Sales got a boost from the company's acquisition of SRS Distribution, along with hurricane-related repairs and warmer than usual weather in much of the US. Still, the company said consumers are being cautious after a period of high rates, and that's why the stock was upbeat here in pre-market, but then followed the market on the way down. Net, I thought this was actually pretty good earnings from Home Depot, considering their size and scale. And then right after the bell very recently, so anything could change from these earnings, Spotify dropped their earnings. Now, very weird. They missed on EPS, beat on sales, but the stock was still up 7% in the after hours. And that's because premium subscribers came in at 252 million. The market's expectation was for a flat 250 million. That's a pretty good beat. Monthly active users also beat 640 million versus 639 million. You love to see that again. The street recognizing the value management delivering in the last quarter, and we were up 7%. I believe there's also some price increases and some more subscriber levels they're going to add. That's further going to boost profits. So all in all, fantastic earnings here from Shopify, Spotify, Home Depot as well. But let's go back to the broader market. And it wasn't all glitz and glamour like it was with the names we just spoke about. XLE, XLP Staples, and XLK, some of these tech names, right, as well as defensives, were up 0.4, 0.13, and 0.08%. So we are seeing a bit of an inverse trade to what we saw yesterday, right? But there is still that defensive angst in staples. And maybe the street is still not fully convinced of what Trump's tariffs might mean. But the majority of sectors today underperformed the market. XLB, the worst materials, followed by XLY, led lower by Tesla. We also saw underperformance in healthcare, real estate, utilities. These were all down 1%. XLE down 0.52%, and the S&P 500 was down 0.36% today, with XLF actually showing mild outperformance relative to these sectors that declined. That really goes to show the strength we are seeing in this sector. And I think what we're seeing with financials is just a little bit of a breather as a sector, from regional banks to the big banks to the investment banks to the trading firms. They've all been rallying, and we're just seeing a bit of a breather before we go higher. I'm still very bullish on financials through the end of the year. And like father, like son, we saw broad market declines in small caps, mid caps, large caps, with small caps really taking it on the chin today. Every single factor segment was down more than 1%. Value, core, and growth, and then mid caps declined slightly less, and then large caps were the outperformer, relatively speaking. But still a red day in US markets, still a red day across the market, and that was the fact globally as well. We saw Asia very, very red. So too was Europe, the US, Australasia. It was a pretty red day across the board, except certain parts of the market, Canada right here, as well as Southeast Asia, but inconsequential really. Europe, Asia, the United States were red. That meant the global market was red. And what we also saw was markets have actually lost their 5-day moving average in terms of breadth. Now, this is a very, very noisy figure. And if we look past the 5-day, the 20-day, 50-day, 100-day, and so forth, still looking very, very constructive. And what we're seeing right now is nothing more than profit taking and just a pullback from the highs after what has been a very quick and strong rally on optimism, on deregulation, and tax cuts. I did say this yesterday that we are going to see a pullback. We are going to see some consolidation, sideways movement into, the middle part towards the end of November, and then we can continue higher into December, into the new year. This is actually very healthy for us to pull back and take some of these profits. It just allows for reinvestment at lower levels, and it aims to take the markets higher. We can't go up in a straight line. Markets do pull back eventually. It's very, very healthy and normal. But let's actually hop on the charts. Now, a big reason why we saw massive underperformance in small caps today, the IWM down 1.75%, the SP 600 down 1.5%, had to do with yields. Yields rose significantly. The 2-year, 10-year, 30-year yield and the dollar rose. And I feel like I say that almost every single video now. And the higher cost of capital is simply putting a weight on the IWM, small caps, as well as being just overall competition for equities. I think people look at like a 2-year yield. Imagine you go get a 2-year bond paying 4.3% risk-free. That's really, really good, especially considering with where valuations are right now. Now, I personally think adjusted for return on equity, like stuff like the S&P 500 and the NASDAQ are slightly undervalued. But when you look at it on absolute terms, PE ratios, the market is expensive. And so, taking a 4.3% 2-year bond risk-free with the market in a clear disinflationary trend, the higher cost of capital and the competition bonds have against equities, those two dynamics are starting to affect small caps or higher beta. And if this does go higher, it will tangibly affect stocks, but I don't think it's going to have the massive pull effect in the next couple of months. I think what we really saw today was just a bit of profit taking. I do think we go higher into the end of the year. That being said, with a higher dollar, Bitcoin also increased. Very interesting to see that, but gold fell, silver gained ever so slightly, and crude was flat. So the market's sort of doing what it normally does, and you see higher yields, higher bonds normally means commodities sell off, bonds sell off. That's exactly what we saw today, with silver being the exception. And equities, I wouldn't even call equities a bloodbath. I mean, the IWM, that's a pretty ugly day, but a very neutral day considering the rally we've had in large caps as well as mid caps. The RSP was down a bit more than I'd like to see on the day, but you have to take it as it comes. And I do think based on the rally we've seen, I mean, the stocks are up like 5-6% since the election. Let's actually take a look and go take a measured move to the highest 5.3% to where we closed 4%. So, you know, a 4% move in the RSP in just 5 to 7 trading days, absolutely crazy. And actually seeing a pullback is completely normal. So what level should we look to for this pullback to actually buy back in? I would say that the very first level you should look to for the RSP is just this level right here, sort of the 182 level. That's probably where you want to get in. We can consolidate around there. I think if we actually break below this level though, right, I think you actually just look at maybe closing the gap. Let's say the 179 level, maybe 178.50. So anywhere in between here, great place to get in, because I do think we're going to see a 200 RSP, not before the end of the year, but sometime in Q1, Q2, 2025. Looking at the S&P 500, we saw some very weird dynamics now. The gamma lines did not change for the S&P 500. But like I said yesterday, there is some asymmetrical downside when we hit the core resistance and it doesn't move up. It did not move up. And that's actually what we're seeing right now. We are somewhat in a bit of a daily downtrend, but we haven't broken key levels, so it's not confirmed as such. And this is a wick right here. If we actually just hop on the 1-day chart, we did see lower lows, lower highs, but we did actually put a bottom in right here. We never retested those lows and we did rally all the way up. So yes, we did see net selling, but we did see buying from the midday onwards. So, you know, the market really seeing value below the 6,000 level, and the market probably saying, hey, we probably are going to go between 6,500 and 7,000 next year. Anything below the 6,000 level probably is great value looking out into the rest of the year. But net right now, equities look very strong. The S&P 500 looks strong. Let's just get a little bit of a pullback. And I do think for the S&P 500, let's just look at the gamma flip zone. We are in positive gamma, but if we pull back to this gamma flip zone, you know, that's when you want to be buyers, and we can actually go higher and break the 6,000 level again. And I'm talking, this is going to be a quick and short, sharp rally towards the middle, back half of November, and then we can rally from there. And I've been saying this for a couple of days, and we are starting to see that pullback. Now, I'm not saying we're going to get all the way to the 95.05 area. We could continue the rally at this level right here. I'm just saying this is a range. You know, these aren't an exact science. I just quote exact levels because it's a lot easier to quote that on a video, especially when I'm recording these, right? Looking at the NASDAQ 100, we saw core resistance move down from yesterday, and like the S&P 500, we can actually see a bit of a pullback all the way to as low as the gamma flip, but we did see some buying net, all things considered. If we actually go ahead and look, like the S&P 500, the market seeing value below the 21,000 area right here, and investors actually buying the dip, getting exposure. And this is what a lot of bulls wanted. You know, they wanted a little bit of a pullback, and maybe we did see a bit of front running, but we did see some consolidation at the high. So we'll see what happens tomorrow. Things looking kind of mixed here in the after hours, but the chart I want to talk about is the RTY. Let's actually go to the daily chart. Now we are still in positive gamma, and like the S&P 500, like the NASDAQ 100, we did see a bit of a pullback from the core resistance, and we're nearly at the gamma flip zone. But what's very interesting is that they put support actually did move down. So that's very, very interesting. So this moved down. So there is a little bit of short bets entering the options market that's being reflected in the gamma lines. And this put support also aligns up with this resistance zone and this resistance zone right here, which is very, very interesting. So if tomorrow we go ahead and break the gamma flip, we're going to aim for this 2300 area, which is technically a very sound spot to take longs for the IWM. But as long as we remain above the 2200 area. Again, very, very constructive in the Russell 2000 because that would just mean a higher low. To be honest, this price action right here, this looks like a technical breakout, a bit of a pullback, right? And really you want to buy the pullbacks and aim for higher price action. The market definitely wants to see new all-time highs in the Russell 2000. We didn't get it just yet, but I think a little bit of a breather and then the last push to get those all-time highs. I know I want to see it. I know you want to see it. The market wants to see it. The street wants to see it. So it'd be very, very good to go ahead and see it this week. All in all though, guys, we are still in positive gamma for all of these indices and we're just seeing a typical pullback. This is like a garden variety pullback. It might extend to 2%. It might extend to 3%, but it's a garden variety pullback that you want to buy the dip on. I wouldn't be concerned at all. Momentum is clearly to the upside. It's been that way, not just in the last couple of days, but for the most part for this year. I mean, if you look at the 1 year chart of the IWM on a percentage return basis, that's a 40% return for the Russell 2000. There's very clear momentum in stocks right now. It's been like that for the last 365 days. And you don't really want to fight this trend. You just want to buy the dips when we do get them. And it does look like we are getting a garden variety dip right here. However, guys, do take into consideration, there's definitely still bulls out there. That's a wick in the S&P 500. That's a wick in the NASDAQ 100. Look at the RSP. That's a wick as well. So bulls are clearly there in the market. Now we can go lower, yes, but you definitely don't want to miss the rally that could come in December. I do think we're going to go higher. I do think we're going to see outperformance in stocks relative to commodities and every other asset class. And we can talk about material downside in the first, maybe second quarter of 2025. But for now, the weakness we are seeing in the market, guys, buy that weakness because we are going higher into the end of the year. Ladies and gentlemen, we are back. Sentiment back in greed territory after what has been a wild 3 weeks, going from greed into neutral, into fear, back into neutral, hovering around here for a little bit, and after the election, pumping all the way into greed territory. And we are probably going into extreme greed if this Trump pump continues. And we have a ton of data and sentiment confirming that. The S&P 500 in the last 7 weeks of the year, when preceded by a 10% or more calendar year, these are the returns we can expect. As of November 10th, the S&P 500 is up 25.7%, and below are the results for each of the 7 last weeks of those 33 prior years in which the S&P 500 was up at least 10% going into the last 7 weeks, and that's November 12th to December 31st. And the S&P 500 has been positive in those 7 weeks in each of the last 16 years in which the trailing calendar year was 10%, as you can see from this green section right here. And going back 74 years, there has never been a 2% loss in that 7-week period in the aforementioned setup, while there was 22 2% gains in that period. Absolutely bullish. So this setup we have here with the election, with sentiment into Fed rate cuts, with a very strong economy, this is setting us up well for what is a very positive time period. The average return in those 7 weeks is 3.5%. Very, very bullish, all things considered. And Tom Lee's fund strat also confirms that. He says, we see positive supports for equities into year end, the median gain post-election, and given no recession, and markets declined prior to the election, is implying a 7% move to S&P 6300 before the end of the year. So very, very bullish stats. If we also overlay it with Trump's last victory in 2016, these are 2016 overlays versus the current market momentum. What do we see in the S&P 500? Yes, we have front-loaded a lot of the gains, but we can actually see material upside into the end of the year. The same is true for US equities versus the rest of the world. The same is true for small cap versus large caps. The same is true for bond yields. In fact, in 2016, bond yields actually rose into the Trump presidency. Very interesting. Real yields rose, break-even inflation rose. The 10 to 2 year yield curve steepened a bit. The dollar actually increased as well, which is very, very interesting. So do expect a big run up in the dollar. However, some of this move may have been front-loaded because we do have the 2016 data. The USD versus the Chinese yuan actually fell. Again, stronger dollar. This is what this means. Gold actually fell as well. Chinese equities fell. And Bitcoin, while actually rallied, we have front loaded a lot of the move, but that's because Bitcoin has actually traded sideways for the better part of about 6 months. So generally speaking, what is this telling us? It's a huge risk on for equities. And another huge supportive factor is actually rate cuts. Guys, we are probably going into a period of high economic growth, higher inflation. That's what break evens are telling us. And that means the Fed are probably going to be slow to cut. They're not just going to juice everything and then spike inflation. And however, slow rate cutting cycles are actually a blessing in disguise for the S&P 500. This is performance for slow versus fast rate cutting cycles. And you can see when rate cuts happen fast, it often implies weaker economic data. The rate cuts are there to support the market and we actually get sideways momentum. Whereas in slower rate cutting cycles, 12 months later, we can actually see returns upward of 25%. So tons of tailwinds in the market, and also going into a post-election year, we tend to see gains through and through. So all of the seasonality, all of the data right now, guys, is pointing to us moving higher. And while we can see a little bit of consolidation, a little bit of sideways momentum, as you can see right here, and yes, we may get volatility, but everything is setting up for us to go seasonally higher. When we really do get the sideways momentum, is sort of towards the middle of next year into the midterms. That's when we normally trade sideways for a full year. In some cases, we can actually trade lower, trade down, but that is a while away and we need to ride the momentum while it's happening. And in our scenario, for equity investors, longer term investors, that means any dips we do get, we want to buy those dips, take advantage of those dips because the path of least resistance is higher. And diving into the macro, guys, we get two big important prints this week, CPI and retail sales. And this is what BofA have to say about each. They forecast CPI core prices rising 0.31% versus 0.3% consensus in October and 3.3% over the last year. At the component level, we expect a large increase in used car prices, another increase in airfares that reflect a slight boost from residual seasonality and strong pricing trends, a slower but still firmer increase in car insurance, and roughly steady shelter inflation. OER 0.33% increase, rent plus 0.28%. The semi-annual update to the health insurance source data points to a softer reading over the next 6 months. Very interesting. So the big components, healthcare and shelter, looking to ease while we should see an increase in used car prices, airfares, and residual seasonality going into this holiday season. There's a forecast headline CPI rises 0.19% in October, reflecting higher food prices and lower energy prices over the last year. Their forecast is consistent with a 0.24% increase in core PCE in October. They also forecast a 0.03% increase in core retail sales, matching the consensus. Their forecast reflects healthy growth in card spending, and they expect a 0.4% increase in headline retail sales, reflecting lower gasoline prices but higher auto sales. Very interesting. So they expect the data to come in line with consensus, but there could be a huge mix-up in stuff like used car prices, shelter, as well as healthcare. It really all depends. Now, for the rest of the week, guys, looking at earnings, we still got a big week of earnings. Maybe not so much in market cap, but in sector movers for sure. This past week so far, we've had Shopify, Ava, Spotify, Oxy report. Tomorrow on Wednesday, we have Cisco, dLoco, After the Bell. And that's really it for Wednesday. Then Thursday, we have Walt Disney, Applied Materials, AST Mobile, Oklo, JD.com, Intuitive Machines, Advanced Auto Parts, who a big day Thursday. And Friday, what everyone's going to be watching is Alibaba Group. And then looking for the rest of the week, we kind of already touched base on this, but we have core inflation tomorrow, CPI. And then on Thursday, we have the PPI. And then Friday, we have retail sales. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm.